What if the person controlling the most powerful central bank in the world actually has far less control than everyone thinks? The new Federal Reserve Chairman has arrived. Michael is out. Matthew is in. And almost immediately the market reacted. But here's the strange part. Everyone expected the new Fed chair to be a dove, someone who would push aggressively for lower interest rates. Even Donald Trump expected that. But after his first major press conference, the market heard something completely different. Instead of sounding dovish, he sounded hawkish. Very hawkish. So hawkish that some people compared him to David. And the bond market reacted almost instantly. The 2-year Treasury yield jumped dramatically in just minutes. That may sound like a small move, but in the bond market, a move of 10, 12, or 15 basis points in only a few minutes is something investors pay attention to. Because markets don't just react to what the Fed does, they react to what they believe the Fed is going to do next. And that's where things get interesting. Because the new Fed chair announced a series of task forces designed to change the way the Federal Reserve operates. Communication, the balance sheet, data sources, productivity and jobs, and inflation. Sounds impressive, right? But here's the question nobody wants to ask. Does adding more task forces actually solve the problem? Or are we simply adding another layer of bureaucracy to an institution that already has hundreds of economists and PhDs? And even more importantly, how much power does the Federal Reserve actually have? Because the market may be telling us something completely different from what the new chairman is saying. And if the market is right, interest rates may be heading lower in the future. But that could actually be bad news. Because lower interest rates don't always mean a stronger economy. Sometimes they mean the economy is getting weaker. So let's break this down in 3 simple steps. And if you want clear, no-nonsense explanations of what the Fed, interest rates, and the bond market could mean for your money, make sure you subscribe. Because by the end of this video, you'll understand why the market may be telling a very different story from the Federal Reserve. Step 1. The market was completely caught off guard before the new chairman's press conference. Investors expected a more dovish Federal Reserve. That means lower interest rates, easier financial conditions, more support for the economy. But after the press conference, the market heard something else. The new chairman appeared much more focused on inflation and structural changes inside the Fed. And the reaction was immediate. The 2-year Treasury yield moved sharply higher. Why does the 2-year Treasury matter? Because it is heavily influenced by expectations for future Federal Reserve policy. If investors believe the Fed is going to raise rates, the 2-year yield tends to rise. If they believe the Fed will cut rates, it tends to fall. So when the 2-year yield suddenly jumped, the message was clear. Investors believed the new Fed chair might be more aggressive than expected. But then came the first problem. The Fed had not actually raised interest rates. The rate decision remained unchanged. So why did the market react as if the Fed had suddenly become much more hawkish? Because markets are psychological. The actual decision matters. But expectations often matter even more. And this brings us to the new task forces. One of the most important is focused on communication. Now on the surface, that sounds harmless. The Federal Reserve needs to communicate clearly. But here's the deeper issue. The Fed doesn't just communicate information. Its communication influences markets. When the Fed says something, investors react, businesses react, consumers react, mortgage rates react, stock prices react. The entire financial system listens. So communication itself becomes a form of power. And that's why the new Communication Task Force may actually be more important than the others. Because the Federal Reserve's greatest power may not be its ability to control interest rates. It may be its ability to influence what people believe about the future. And that is a very different kind of power. Then there's the balance sheet task force. The Fed has spent years expanding and shrinking its balance sheet through programs like quantitative easing and quantitative tightening. But here's the controversial question. How much does the balance sheet actually matter to the real economy? Because before the financial crisis, the amount of bank reserves remained relatively stable for decades. The financial system functioned without trillions of dollars in excess reserves. Then suddenly, the Fed expanded its balance sheet dramatically. So the question becomes, are all those reserves truly necessary? Or does the market simply react to them because investors believe they matter? Here's a simple analogy. Imagine every vehicle in the economy ran on electricity, and then someone told you the government was increasing or decreasing the amount of gasoline available. Would that change how the electric vehicles operate? Probably not. And that's the argument being made about bank reserves. The Fed can increase them. The Fed can decrease them. But that doesn't necessarily mean those changes have a major impact on the actual monetary system. The impact may be mostly psychological. And that same argument leads us to the most important question of all. How much control does the Fed really have? Step 2. The Fed may not control interest rates as much as you think the Federal Reserve controls the federal funds rate. That's true. But here's the question. Does the Fed actually determine where interest rates would naturally be? Or is it simply following the market? Consider the 10-year Treasury yield. Unlike the overnight rate, the 10-year yield is largely influenced by market expectations, growth, inflation, economic conditions, future demand for money. The market is constantly trying to predict the future. And the 10-year Treasury is one of the clearest signals of those expectations. So imagine the Fed sets its overnight interest rate at one level, but the market sets the 10-year Treasury yield at another. The difference between the two can tell us something important. Historically, the gap between short-term rates and long-term rates has often been around 100 basis points. Today, that gap is much smaller. And that matters, because when the short-term rate rises while the long-term rate barely moves, the yield curve flattens. And when the yield curve flattens, the market may be saying, "We don't believe higher interest rates will last." Think about that. The Fed can talk tough. The Fed can say rates may remain higher. The Fed can create new task forces. The Fed can issue new forecasts. But if the bond market doesn't believe the story, the bond market doesn't have to follow. If this is making the relationship between the Fed and the bond market clearer, hit the like button. It helps support the channel and lets me know you want more breakdowns like this.
Do you think the Fed will raise rates again or cut them next? Drop your prediction in the comments.
And this is where the new Fed chair faces a serious problem. He can sound hawkish, but the market may still believe that the economy will eventually weaken. And if the economy weakens enough, the next move in interest rates may not be higher, it may be lower. This is the difference between what the Fed says and what the market believes. And historically, those two things have not always been the same. The Federal Reserve has repeatedly made forecasts that turned out to be wrong. Inflation was supposed to be temporary. It wasn't. The economy was expected to behave one way. Then something completely different happened. And this is the uncomfortable truth. The Fed has enormous resources. Hundreds of economists, hundreds of PhDs, massive amounts of data. But having more data doesn't guarantee better predictions. Sometimes you can have thousands of experts and still get the future completely wrong. Which brings us to the third step. Because the yield curve may already be telling us what it thinks about the new chairman. Step 3. The yield curve may be sending a warning. Remember what happened after the press conference. The 2-year Treasury yield jumped. Investors initially believed the new Fed chair was hawkish, but then something interesting happened. The 2-year yield began to move back down, and that tells us the market may have reconsidered its first reaction. Now look at the relationship between the 2-year Treasury and the 10-year Treasury. The difference between them is relatively small. The yield curve is relatively flat, and this is extremely important. Because if the market believed the economy was entering a period of strong, sustainable growth with persistent inflation, long-term interest rates would likely rise more aggressively. But when short-term rates rise while long-term rates remain relatively contained, the market may be saying something else. It may be saying, yes, the Fed can talk tough right now, but eventually economic conditions may force them to cut rates. That is the message the yield curve may be sending. And if that's true, the new chairman could go from being perceived as a dove to being perceived as a hawk, and then eventually back to a dove. Not because the Fed suddenly changes its personality, but because economic reality forces it to change direction. And that has huge implications for investors. Because lower rates sound like good news. But you have to ask, why are rates going lower? Are they falling because the economy is becoming stronger? Or are they falling because the economy is becoming weaker? Those are two completely different situations. Lower rates can help stocks, they can help housing, they can reduce borrowing costs. But if rates are falling because businesses are slowing down, unemployment is rising, and economic growth is weakening, then lower rates are not necessarily a sign of prosperity. They may be a warning. And this is where investors often make a major mistake. They focus on the Fed. They listen to every speech. They analyze every word. They obsess over every rate decision. But the Fed may not be the most important signal. The market may be more important. Because the market is constantly asking one question, what happens next? And the yield curve is one of the ways the market answers that question. So here's the big takeaway. The Federal Reserve has two major tools. The first is interest rates. The second is its balance sheet. But the argument is that neither tool gives the Fed unlimited control over the economy. The Fed can influence, it can encourage, it can discourage, it can change expectations. But it cannot simply wave a magic wand and create economic growth. It cannot force entrepreneurs to hire. It cannot force consumers to spend. It cannot completely control inflation, and it cannot predict the future with perfect accuracy. So what is the Fed's greatest power? Psychology, communication, expectations, the ability to convince millions of people that something is going to happen. And then influence their behavior before it happens. That may be the real power of the Federal Reserve. Not controlling the weather, but telling everyone what the weather is supposed to be. And sometimes the market listens. Sometimes it doesn't. Now, the new chairman may believe that creating new task forces will improve the Fed's performance. But here's the uncomfortable question. If the previous system repeatedly failed to predict the future, does simply adding more people and more committees guarantee better results? Or does it just create a bigger version of the same system? Because more experts don't automatically mean more accurate predictions. More data doesn't automatically mean better decisions. And more complicated systems don't automatically produce better outcomes. Sometimes, the most important lesson is much simpler. The Federal Reserve is powerful, but it is not all powerful. The new Fed chair may change the communication. He may change the task forces. He may change the balance sheet strategy. He may sound more hawkish, he may sound more dovish, but the economy still has the final vote. The market still has the final vote, and eventually reality has the final vote. So when you're thinking about your portfolio, don't simply ask, what did the Fed say today? Ask a better question. What is the market saying about the future? Because the Fed can make a prediction. The market can disagree. And history has shown us that the market is often more focused on what actually happens next. The new chairman may promise change. The headlines may scream that everything is different. Investors may panic. Markets may rally. Interest rates may rise, then fall. But sometimes, after all the announcements, after all the new task forces, after all the bold promises, the biggest change is that everything looks different, while the underlying system remains exactly the same. And that may be the most important lesson for investors. Don't blindly follow the headlines. Don't assume the Fed controls everything. And don't confuse confident predictions with certainty. Watch the data. Watch the bond market. Watch the yield curve. And most importantly, watch what reality does next. Because when the Fed says one thing, but the market says something else, that disagreement may be where the biggest opportunity and the biggest risk is hiding. And if the past is any guide, the more things change, the more they may stay exactly the same. If you found this breakdown useful, make sure you like the video and subscribe to the channel for more clear, practical analysis of the Fed, interest rates, markets, and the economy. Because the next major market move may not come from what the Fed says, but from what the market realizes next.